Good evening, everyone. I'd like to call the Town of Monroe Pension Committee and OPEB Board of Trustees joint meeting to order. Today is Thursday, October 23rd, 2025, and the time is 6:01 p.m. Please note that the meeting will be recorded and made available on the town's website in accordance with state law. I'm going to do attendance. Steve Kirsch.
Present.
Jonathan Formicella.
Here.
Jason Maurer. Dennis Condon, I don't see here. Christy Martinez. Okay, Frank Duchess.
Here.
Joe Cobson.
Here.
Mike Vitello.
Here.
Ron Banowski.
Here.
I think that's everyone. And then we also have Craig Hirsch and Sheila Castanelli. All right, and then we have Devin Francis, our advisor. So let's move on to the review of the minutes. Is there a motion to accept the pension committee meeting minutes and voting record for July 31st, 2025?
So Steve Kirsch, second.
Any discussion? I can't do all in favor, right? Or for this, we could for.
Well,
pension.
just call for the pension committee to vote on it.
Right.
Yeah.
So for pension committee, all in favor?
Aye.
That passes unanimous. Is there a motion to accept the OPEB Board of Trustees meeting minutes and voting record for July 31st, 2025 regular meeting?
So moved.
Is there a second?
I'll second it. I'll second it.
Any discussion?
No.
So for that, I'll do Mike Vitello. Just say aye. for
Yes.
nay. Okay,
Aye.
Ron Banowski
Yes.
and Jonathan.
Here, aye.
Okay, so that passes unanimous. Thank you. For new business, we're going to move on to our quarterly investment review through our third quarter of 2025. So I'll pass it over to Devin.
Wonderful, thank you. So everyone should have a book. Mike, do you have a copy? It was in what Ron, you and Heidi sent out. So, yep. Okay, so please let me know, Mike, if you can't follow along and you need me to I don't know, mention page numbers more aggressively or something. Okay, so
No problem. I'll follow along. Go ahead.
Great, thanks. Okay, we'll start with the fiduciary governance calendar, which is on page 6. So this quarter, it's an update on the municipal landscape. So here on page 7, we have a snapshot of the funded status of the various plans. So on the top half of the page, we have the 2 pension plans, the town and then the Board of Ed plan. And then below that, we have the OPEB plan. So what we have here is comparative sets of numbers. So the prior valuation report from 2022, and then the most recent from 2024. And then the val report will be done again in 2026. So we've got an every other year cadence. But I wanted to call out the funded status of the plan, which is remarkably healthy. So you can see for both the town retirement income plan and the Board of Ed plan, you are at 99.3% funded. So almost 100% funded. In just a couple pages, we'll get into how some of your peers are doing. And you are in a much healthier place than most municipal pension plans. And then within the OPEB, you are above 95% funded, which is astonishingly ahead of where most plans are. So very well done in terms of the commitment and the discipline and continuing to fund the pension and the OPEB. In terms of actuarial return assumptions, this is something that we've discussed, I know, many times at this committee. The return assumption that's being used for the pension plan is 6.75%, and for the OPEB, a little bit lower at 6.5%. And we'll talk about how that stacks up relative to peers. So on page 8 and page 9, we talk about the return assumptions across most plans throughout the state of Connecticut. So the average rate of assumption is 6.43 for municipal plans. So at 6.43, you think about your pension actuarial return assumption at 6.75, you are a little bit higher than the average, but certainly not an outlier. And the, if you take a look at the graph on the bottom right-hand side of page 8, you can see that the trend of lowering return assumptions has pretty much leveled off. So now that the average return assumption is somewhere in the neighborhood of 6.5%, we haven't really seen most plans continue to lower that. 10 years ago, when the average was up over 7%, it's pretty hard to justify a 7% return expectation. So it does seem reasonable that it came down to 6.5%, but now that most plans are at about that level, the trend of reducing the return assumption has petered out. If you look at the bar chart on the left-hand side of page 8, you can see the percentage of plans that have an actuarial return assumption between, all of these various ranges. So your range at 6.5 to 6.74%, 28% of plans have a return assumption in that range. Oh, actually, I suppose you're really in the next one. You're at 6.75 to 6.99. 25% of plans are in that range. So, anywhere between 6.5% and 7% of plans, if you add up those two cohorts, you're at more than 50% of municipal pension plans. So obviously the majority of plans fall into that kind of mid-level range. You have a handful that are higher, and then a fairly good allocation of plans that have a lower return assumption. But, bottom line is you're in pretty good company, slightly higher return assumption, but nothing that's outside the realm of reasonability. And then on page 9, we break it up according to the size of the plan. So you would fall in that second category of plan assets between 10 and 49 million. So the average investment return assumption for plans of that size is 6.54%. And then in terms of funded status on pages 10 and 11, here's where you can see that your town's plans really stack up quite well. So the average funded status for municipal plans in fiscal year 24 was at 74.3%. And again, reckon back, you are at 99.3%. So you are about 25 percentage points better funded than the average plan across the state of Connecticut. And then if you again compare your peers on the following page, page 11, your peer group has an average funded ratio of 80%. So still you're well above that.
So how were we historically? I mean, what's missing for me on this graph, it would have been another line. That would
Oh,
show
where you
we
are, yeah. You've consistently been healthier than the average. Yep. So it has trended. I think you were always in the 90s since I've been overseeing the plan, but yeah. But I think it has improved over the past, 8 years or so. So a couple percentage points each year. And then in terms of OPEB, you can see some OPEB stats on page 12. The average return assumption for OPEB is 6.25%. You're at 6.5%. So again, just, modestly above the typical return assumption. And the funded status of OPEB plans is 53%. And again, you are at more than 95%. So very healthy funded status for the OPEB plan, which is not typical. So well done. Any questions about the governance calendar before we get into the capital markets? Okay.
I have one question. This is Mike Fratello. How often is the plan reviewed? Is it weekly, bi-weekly, monthly? How often is it reviewed?
What do you mean reviewed, Mike?
Like, in other words, looking at the plan for its progress or, where it's going.
Well, we meet quarterly. I mean, is it looked at, more than, we get monthly statements, so I would say it's looked at monthly at least. Are we looking at it every day? No.
Okay. So basically, all right, that's what I just want to know, if it was looked at, prior to our meetings, our quarterly meetings.
I I guess I don't understand that.
By who? But are you asking if our advisors looking at it or the board?
The plan administrators.
Well, the
So
board is.
right,
the
yeah.
plan, yeah, so we are.
Oh, okay.
Yeah, I think quarterly is a pretty typical cadence, Mike. And you know, as the advisor, we also are not looking at it on a daily basis, but we do have certain kind of flags in our system. So if anything gets out of whack, if we think about the target allocation and then something, you know, the markets have a really big dislocation and the allocation gets out of whack, we will be proactive in rebalancing. We are monitoring the custodial accounts. So if there's, let's say you make the annual contribution, we kind of have an alert. So then we'll reach out and say, you know, like, okay, we're going to invest some of the cash, leave some aside for pension payments. So we're at Fiducian, Mike, we are monitoring it more than on a quarterly basis.
Oh, okay.
Is that helpful?
Yeah, yes, absolutely. Thank you. Thank you
Okay,
for that answer.
Great,
Thank you.
yep, you're welcome. Okay, so let's talk about capital markets. So if we pause here on page 14, which is the first page in the capital markets section, you know, one of the biggest pieces of news through the third quarter was the Fed reigniting their rate cut campaign. So they cut rates by 25 basis points at their September meeting. By and large, the expectation is that they will cut rates again at their meeting next week. And then we could see a couple additional rate cuts before they, you know, take another pause. But remember that the Fed is and has always been data dependent, and they really have two goals in mind. One of their goals is steady inflation at about a 2% rate, and then full employment. And right now, those two objectives are kind of working against each other. So we actually have weakening labor numbers, which you can see on the left-hand side of page 14. So jobs have decreased, the unemployment rate has increased. So even though the labor market by and large is still pretty healthy in terms of the trends and the direction of where the labor market is going, we do see some softness. And that's really what allowed the Fed to say, okay, the data is such that we feel comfortable cutting rates. That was at their September meeting. Now, inflation is likely to be trending in the other direction. So there was a lot of concern earlier this year when President Trump announced the new tariffs, and there was concern that inflation would reignite very substantially and that we'd see those CPI numbers skyrocket. That did not happen, but there were a lot of dynamics going on where, you know, companies were kind of front loading inventory before the tariffs went into effect, and you know, some various practices that allowed for those CPI numbers to remain fairly steady. But we are starting to see a little bit of an uptick in CPI. Since the government has been closed, we didn't get the CPI reading when we were supposed to, although it is supposed to come out tomorrow. I was listening to Bloomberg on my way down, and those folks were saying that they are expecting a bit of an increase in the most recent reading, which would indicate an annualized CPI number of just over 3%. It remains to be seen whether or not that will actually come to fruition. But if you think about the target of 2%, 3% is meaningfully above that. So you have the inflation numbers perhaps suggesting that the Fed should not be cutting rates, but then you have the employment numbers suggesting that they perhaps should be. So it's kind of this, they're trying to strike the right balance. And also, of course, there's been political pressure for the Fed to be cutting rates. So kind of a complex situation, but the basic expectation is that the Fed will continue on that rate cut campaign for another 2 or 3 cuts. In terms of market returns, one of the things that's been really interesting so far this year, which you can see on page 15, is international equities have substantially outperformed domestic equities. That was not the case for the prior 15 years, where we actually had decent returns from international equities, but not anywhere close to what we saw in US numbers. So what you see on the left-hand graph of page 15 is the relative outperformance of the international markets compared to the S&P. So the emerging markets is shown by the royal blue line, developed markets is shown by the navy blue, or what kind of looks like a black line. Emerging markets is outperforming the S&P by about 13 percentage points year to date, and developed markets are outperforming by about 10 or 11 percentage points year to date. So we've seen, kind of international equities come out of the gates super strong in 2025 for the first 9 months. And that has been beneficial to a lot of our portfolios where we have a pretty substantial international weighting. Previously, that substantial international weighting was serving as a headwind, and now it's turned into a tailwind. And then another factor that's been kind of an interesting dynamic is the relative performance between small cap and large cap. So on the right-hand side of page 15, you can see this shows the leverage used within small cap companies represented by the Russell 2000, and then within large cap companies. As you can see, the leverage within small caps is about 2 times what is present in the large cap companies. What that means is that these companies are more heavily reliant on debt. And so we saw a resurgence in small cap companies in Q3 because of the Fed's first rate cut. As the Fed continues on this rate cutting campaign, that will be more of a tailwind. It will be more beneficial for smaller companies. And so we should see small companies outperform. Up until this point, they have not. They have substantially lagged large caps. So that's kind of an interesting dynamic that's going on. There's also been some other dynamics within the small cap space, which I'll talk about when we look at the portfolio performance a bit more. But then on page 16, you can see the asset class returns so far this year. So really everything is in positive territory across the fixed income universe, across the equity universe, across the real assets and hedge funds and commodities. Everything has produced a positive result so far this year. The circles represent the Q3 result, and then the bars represent the year-to-date result. So other than the takeaway that everything's in positive territory and performing well, I think the biggest visual takeaway from this page is the substantial outperformance of the international markets. You can see those bars being well above everything else. So again, that has been beneficial for your portfolio. And then I always pause on the quilt chart. So if we flip ahead a couple pages to page 20, again, just to underwrite the importance of diversification. So what this shows us is all of the last 10 calendar years. At the top of each column is the best performing asset class from that year, all the way down to the worst performing asset class. There's no discernible pattern. You can't predict whether last year's best performer will be next year's best performer, but this balanced portfolio shown in the orange box is always kind of middle of the road. So by having your assets spread across many different asset classes, you help reduce the overall volatility and create that smoother return stream over time. Any questions about anything within the capital markets? Okay. So if we move ahead to page 22, this is the portfolio dashboard for the town plan, the employees, and then Board of Ed is a few pages later in the book, but very similar results overall. So again, looking at the absolute numbers, it's been a really very strong year so far. On a calendar year-to-date basis, the portfolio is up 13%. On a 1-year basis, the portfolio is up 10.8%. And then we look over the last 3 years, the annualized return has been 16.5% per year over the last 3 years. So thinking about that in context of our return target, which is 6.75%, the last 3 years, you've really blown that out of the water. When we look back on a longer term basis, the 10 years since inception, you're looking at a 7.2% annualized return. So still strong and still outperforming that return assumption, but obviously the last 3 years has been in particular a really strong market environment. You do see some relative underperformance when we compare it to the portfolio benchmark on a year-to-date and one-year basis, and I'll talk a little bit about that. That's primarily the small cap exposure that has been creating that headwind in recent history. And then in terms of assets, we ended the quarter, you can see on the top right-hand side of page 22, at just about 16.95 million. So pretty healthy asset profile. And in terms of asset allocation, you can see that on the bottom right-hand side, we are pretty closely aligned with our target allocation, which is 30% to fixed income, 40.5% to domestic equity, 25% to international equity, and then 4.5% to real assets. And then we have that same asset allocation snapshot on page 23, but you can also see the allowable guidelines within the table all the way on the right-hand side. So you see a column that says minimum allocation and maximum allocation. Those are the parameters that are outlined within the investment policy statement. And of course, we are always going to be making sure that the portfolio is well within those allowable parameters. We always need to be in compliance with the IPS. Page 24 shows all of the underlying holdings within the portfolio. We have not made any changes recently. We don't have any recommended changes for this evening. I will mention that the Conestoga Fund, which is listed as the last strategy within domestic equity, has recently been placed on watch status. So you can see that on page 27, we have a little blurb about the watch status. And when I initially sent out this report last week, Conestoga had not yet been placed on watch. So if you reviewed the first version of the report, it showed all of the managers as maintained. This watch status is fairly recent, and it really relates to the magnitude of Conestoga's relative underperformance, which we'll talk about in just a moment. And then also there is a pending portfolio manager retirement. Typically, if the fund was, performing fine, we might not be as concerned about that, but due to the relative underperformance, we're just keeping a closer eye on the transition, making sure that everything remains okay. But no recommendation to make a change at this point in time. We're just keeping close tabs on it. And everything else is very much on maintained status. And then page 25 shows a snapshot of your fixed income portfolio. So the fixed income represents about 30% of the overall portfolio. And then you can see in this top box and the third column, the weighted average yield is 4.4% and the weighted average duration is 5.5%. And by and large, the assets are primarily invested in investment grade securities. So pretty high quality fixed income. So if we flip ahead just a couple pages and take a quick glance at pages 28 through 30, this is where we can see all of the asset class composite results and then the results of each of the underlying managers as well. So for fixed income, you can see on a year-to-date basis, this segment of the portfolio is up 6.5%. It is outperforming its benchmark, and it's also ahead on all other timeframes, 1 year, 3 year, 5 year, so on and so forth. So very strong at relative performance from the fixed income managers. In particular, the BlackRock Strategic Income Opportunities Fund has been super helpful over the past year when the aggregate index has been up not even 3%. The BlackRock fund has been up 6.4%. So having that, we call that an unconstrained fund or a dynamic fixed income fund, that has been very beneficial in terms of the relative performance.
Just curious on that. The numbers are great. Why is it a double B rating?
Yeah, so it's a very eclectic portfolio. So they don't try to replicate the aggregate index. So the credit quality can be down. They do have exposure to high yield. They do have exposure to things like emerging market debt or developed market debt overseas. What they try to do is most traditional bond managers have very high interest rate sensitivity. So as interest rates change, that's where you'll see the bulk of their performance change. What BlackRock does is they take a risk budgeting approach where they try to have the risk spread across a variety of factors. So interest rate risk is only a very small segment of that. And then you do have some credit risk, you have some currency risk because of the international exposure. So it's by nature, it's a lower quality portfolio generally, because they're not trying to have that investment grade, super high quality. But it's not, we don't consider it a risky portfolio.
I mean, BlackRock is very solid.
Yeah.
I was just curious because I was looking at all the others, they were either AA or A, and then I saw that as BB.
Right.
Yeah, we took a return.
Yes.
And generally, you may see a higher return when you're looking at something a little more risky.
Right. Yeah, it's and what's interesting about it is that what they're actually trying to do is achieve a positive absolute return in any type of interest rate environment. So when we were in a rising interest rate environment where we saw negative returns from most traditional fixed income managers, they were actually producing positive returns, just a little bit, eking out a slightly positive result. But it's a very eclectic approach. They are not anything like the other managers. Yeah, you're welcome. All right, so if we look at the top of page 29, this is where we can see the domestic equity performance. So on a year-to-date basis, collectively, your domestic equity managers are up 11.1%. On a one-year basis, they're up 12.8%. So you might look at those numbers in absolute terms and say, oh, wow, everything's great. Those are pretty strong results. But when compared to the benchmark, you see some relative underperformance. To a certain extent, you see underperformance from Diamond Hill, but Conestoga has really been bringing this overall relative performance down. Now, I mentioned that Conestoga has been placed on watch in part due to the magnitude of the underperformance. However, we completely understand why they have underperformed. I wish I'll follow up with it after the fact because we have an interesting chart that shows over the past 6 months, when we think about the small cap rally that we've seen since April 8th. So April 2nd was Liberation Day when the tariffs were announced. April 8th was when the tariffs were kind of rolled back and we saw a rebound in markets. Since April 8th, only 10% of active small cap managers have beaten the index. And what has been driving returns in the small cap space in particular has been very low quality stocks and unprofitable stocks. So stocks that don't have positive cash flow, that don't turn a profit, stocks that are highly levered, stocks that are shorted very frequently, those have been the best performers within the small cap market. Conestoga is a high quality conservative growth manager. They will not invest in a company that doesn't have positive profits. They won't invest in a company with a lot of leverage. We wouldn't want to be using a fundamental manager that says, oh yeah, we're out there looking for the lousiest companies with the worst balance sheets. Like that doesn't really make sense. But that has been the market environment where those have been the names that have really surged over the past 6 months. When we look at the long-term history, and these are the charts that I'll share, it is profitable stocks, high quality stocks, lower leverage stocks. Those are the ones that do outperform over time. So we are confident that given time, Conestoga's performance will probably turn around, but it definitely has been very, very weak, to say the least, in recent history. So it's really been the year-to-date results that have, and actually in Q1, I think they were doing fine. So it's been the last 6 months that have been dragging down those one-year numbers.
So I assume the anticipation with the rate cuts, you see this, if they do the rates, you
Yeah.
see them bouncing back.
It should be, yes. Now, the fact that they try to avoid the highly levered companies, maybe some of those lousier companies will bounce back more strongly. What Conestoga is known for is downside protection. So when we look at years where the markets are negative, they tend to not be down as much as the broader markets. And over time, having that downside protection can lead to longer, to stronger positive results. But we haven't been in that type of market environment. So it is our expectation that we should see them rebound, but, you know, the jury's still out, and it's a concentrated portfolio. It's only about 35 stocks. So, highly dependent on stock selection, and, you know, we need to see those specific names turn around. So, I don't expect that they are, you know, it was, the research team really struggled with the decision of putting them on watch, because we typically don't put a manager on watch if they underperform but are adhering to their stated philosophy and style. But in this case, you know, the magnitude of the underperformance is so substantial that it's kind of, and they have the pending leadership change as well. So, we'll continue to keep close watch on it, but, as of right
They
now,
have
we
a
want to stay
decent
the course.
long-term record. though.
Yeah, 10 on the 10-year basis, they're still in the top quartile of the peer group, even despite the significant outperformance over the past year. So, yep, so I'll just ask you to be a little patient with those fellas. And then on the international equity front, a slight amount of underperformance year to date, but look at those absolute numbers. That segment of the portfolio is up 24.6% so far this year. And then you see relative outperformance on a longer term basis. So up 16.9% on a 1-year basis. And again, thinking about the way that we put our portfolios together within international equity, you have Dodge and Cox, and then Axiom, which is accessed through the John Hancock vehicle. Those are both focused on the developed markets. Dodge and Cox is a value strategy. Axiom is a growth strategy. So we think they're a good pairing. And then same kind of pairing on the emerging market side, with ARGA being the value manager, GQG being the growth manager, and together that pairing is strong as well. So when one underperforms, like it's been a really difficult environment for GQG because of their positioning, but ARGA is positioned kind of the opposite way, so they kind of balance each other out. And then finally, the last piece of the portfolio is the real assets. So we've got the principal diversified real asset strategy. You're looking at strong absolute returns, a little bit of weakness in relative terms, because they've been more defensively positioned. They didn't expect markets to be as strong as they have been. But again, you know, the reason that we want that exposure in the portfolio is for diversification benefits, and they certainly have provided that. So we're comfortable with the pension plans as they currently stand in terms of both underlying manager exposure and allocation. And then we can spend just a couple minutes talking about the OPEB plan, which is not nearly as exciting because it's almost all indexed. So if you flip ahead to page 53, you can see the results of the OPEB. So for the quarter, this portfolio was up 5.7% on a calendar year-to-date basis, up 14.6%, and then 12.2 on a 1-year basis. So very strong absolute results. Similar profile on a 3-year basis, up 16.1%. And again, thinking about it in regards to the return assumption, you have a return assumption of 6.5%. So you are well outperforming that across all timeframes. And you can see that this portfolio is very closely aligned with the target allocation because we have very little active exposure in the portfolio. Most of the underlying funds are passive funds. And in terms of assets, looking at the top right-hand side, we ended the quarter at just about $3.5 million. Very similar allocation profile as the pension plans of 30% fixed income, 70% return seeking assets. And then page 55, you can see a snapshot of all of the underlying holdings. So the fixed income is active. We have Baird on the traditional bond side, and then we have that same BlackRock Strategic Income Opportunities Fund. So those are the only two active managers in the portfolio, and then the remainder is passive through index funds. So again, no recommendations for any changes. The portfolio is doing what we think it should be doing. So any questions for me or anything you'd like to discuss in more detail?
Hey, everybody. Just no question. You guys were just mid-presentation when I was able to join. It's Jason Maurer. Just wanted to say that I was here, and was able to catch most of that. So thank you.
Thanks, Jason.
Not specific to this plan, but either a personal or company view, what do you see in terms of number of cuts between now and June next year?
I think they'll probably end up with about a full percentage point in cuts. So I think 4 total. We've already had 1. That's our baseline expectation.
All right. I was thinking we're looking at maybe 4 to 5, not counting the one we just had.
Okay,
Only
4 to
because
5
you're
more,
gonna
yeah.
have a change of leadership there,
Right.
which has a more aggressive view on it.
Yep, that's absolutely sure. I think rather than seeing more rate cuts than expected, I think we'll see more dissenting votes than expected. So new leadership, they still have to have its majority rules, but I think that the dot plot will be a little more scattered, whereas it's been pretty consistent. So yeah, it's definitely an interesting. The Fed has never been so interesting as it has been over the last 9 months or
I
so.
think a large part of that's gonna depend on inflation though.
Yes.
That's the wild card.
Right. Where, yeah, if we get those numbers that are consistently above 3%, and if the labor market, rather than continues to weaken, just kind of stays steady, it will be hard for them to justify continued rate cuts. So.
The only thing that puts, if you look at the bond market, though, the bond market's saying that the rate should be lower already,
Mm-hmm.
right? I mean, the bond market would say almost by a point right now.
Right. Yeah, so we could see at next week's meeting, I wouldn't be surprised if we see a couple governors vote for a 50 basis point rate
Yeah,
cut rather
I'm-
than
I'm
25.
sure you will,
Yeah,
but we're not gonna get 50.
no, definitely not. Well, I mean, I suppose I can't say that, but I would be very surprised.
I'd be surprised with you.
Yes.
All right, any other questions? Thank you.
Welcome. Very welcome.
All right, so next we have for the pension committee, we have the discussion of the summary plan descriptions for the town and Board of Ed plan participants.
I read through it this week. It looked pretty solid to me. I probably didn't go through with a fine tooth comb, but what I saw looked pretty good.
Okay. So,
As I said before the meeting, there's one typo that's in there on page 13 at the top. There's a formula, and it's supposed to be a number divided by 12, not a number plus 12. That symbol is correct in the Board of Ed. In the other, but in the town side, there's a typo. I only got a chance to really skim it, so I don't really have a lot of comments, to be honest.
okay. So I reviewed it and I want to make a recommendation to have a workshop. Because so there is that calculation error in 2 spots. But I also have some language and structure recommendations. Just for consistency and cross-referencing. I felt some of the answers were very long. And for the recipient of this document, I want the information to
Accessible.
be accessible, but also with accuracy and precision in the messaging across both of the documents. And, I used kind of tracked all my edits and everything. So I would like to table the vote and have a workshop, work with Craig and Sheila on some of those. And for any member of the pension committee that wants to participate, just because I want the participants to, when they're making their retirement decisions, to really understand some of these important options, so. And since the pension board is the plan administrator, I combed it and I have even glossary terms that I'd like to add that were kind of in there, but not in the glossary, so I just want to be a little bit more thorough with it.
That's what.
I think that's a great idea. I had when I reviewed it, some language massaging that could be done in it as well. Nothing that was I felt was necessary that I wouldn't feel comfortable supporting, but I think there's some better ways to phrase some of it, like you said, make it more understandable and accessible. So I think that's a great idea, and I'd be happy to be a part of that workshop.
Okay, great.
Question, would like to have Sharon, who is the composer of such?
Yeah, so
document?
legal counsel drafts, right?
Yes.
Yeah, so I would just say probably what would be best is any changes to have maybe everyone maybe email the chair any changes that they have now, or you can
Okay.
give a timeline for any changes that we'll collect all the requested changes and then run them by council for council to develop an opinion as to the drafted document, and then have the workshop and have council here as well as anybody else the chair would like to discuss the changes and then ultimately vote on a final document.
Okay, so as far as a deadline, do you think two weeks is enough?
I would leave it however long you think it would take to get that opinion from council and for everyone to send the changes. Maybe, I don't know if you want to give everybody a week to send their thoughts to you in an email, and then or if there was any changes anybody had, and then you probably want to give council a week or two to review it, because it kind of depends on when council can offer that opinion.
Okay.
So you're probably looking at about 4 weeks, I would say. So if you met back in a month, I know we've ongoing negotiations where the teachers unions are, I'm sure, interested in reviewing this with their members for final documents, but you're probably looking at about.
Yeah, actually, yeah, the certified staff is, on the board side, it's just the certified staff.
Okay.
Yeah.
Okay,
Yeah.
good. But you're probably looking a month, I would say, between getting opinion from council
Okay.
and then voting, meaning legal counsel, not town council, but and then voting on a final document maybe at that workshop.
Okay. All right, so as far as folks getting me their edits or commentary, can I put November 1st? How's that deadline?
It's probably fine. The only thing we also have to be aware of is there's a possibility that there may be different members of this board, because we have an election in a month, but I believe this will be done before anyone's sworn in, so it shouldn't be an issue if it's resolved before then.
Okay. Okay, so Jason, if you're following, if you could have your edits to me by November 1st.
Yep, that's no problem.
Okay. And then I guess, should I work outside of that too?
Yeah, I mean, just my recommendation would be collect any notes you have and then get it to legal counsel in their opinion and anybody else's opinion from a professional standpoint.
Yeah.
And then get the pension committee together for that workshop and potentially an anticipated vote that night to adopt the changes.
Okay.
That's probably the quickest way to do it, probably.
So should we set that workshop date tonight?
We don't, because we need to make sure that council is there and anybody else's opinion you want to express that night. So it'll just have to be a special meeting. So you would call a special meeting you need, a day's notice, but, if you can give people a few days and just will be in communication with anyone that you want there along with the members of the pension committee
Okay.
to then meet.
Just, Ron, do you think, tomorrow we can reach out to Sharon and give her an idea of what we're doing and?
We could, I guess, so you'd be looking to get the documents to her.
By like, say, the 3rd of November, right?
The commentary.
Right, any suggested changes or questions that people had.
So they'll review the changes.
So if we kind of get that maybe on her calendar, on her thing, where maybe she could be ready to maybe take care of that in hopefully a week or two.
Yeah, so as far as organizing the input from everyone,
Mm-hmm.
I don't know, were you gonna organize like put it into one document?
I can do that.
Okay. And then we could just pass it along to her, have her review it.
Yeah, if everyone just emails me to my town email, then I'll combine them.
Yeah. So I guess just make
And I
sure. Sorry, Jason, go ahead.
I was just going to say, and I would suggest we let council know now that on November 3rd or thereabouts, we're going to be sending over some questions and proposed changes for her review and commentary so that she kind of has it on the calendar.
Yeah. So
Okay.
she's probably going to be the hardest person to lock down for the meeting. So
Okay.
I would just probably say we probably would defer because the rest are pension committee members and town staff. So
Okay.
Is it something you want us to like maybe throw a date out to her, like the November 20th, or that we're trying to, or anything like that, or?
Well, Thanksgiving is what, the 27th?
Correct.
Okay. Yeah, I mean, the 20th is fine for me.
no,
There is a
Or-
board of finance
Oh.
meeting that night.
Yeah.
we do before if you want, right?
Well-
If you want to just make one bad night for yourself.
We do it after Board of Finance.
That's a really bad night.
Yeah.
Or you do it Wednesday, or you want to do it, Rebecca. But you want to do it that week and then kind of
Yeah.
leave it to an individual that maybe have a more difficult schedule that we need to have there.
Yeah, I mean, the problem trying to do it the same night is if you've got people that aren't with the Board of Finance, then they're sitting around, and otherwise, if you start it first, then you have no idea how long this work is gonna run.
Well, if
When-
everybody has access to the change doc.
Yeah,
We could-
well, that's what I was gonna say. If
Maybe
everybody gets a
She's
red line document.
And Ron, we can get back to you and let her know after we
Okay.
give her a heads
If
up.
she could give us 2 options, that would be helpful.
Mhm.
Okay.
Yeah.
All right, perfect.
Yeah, because the only way I think we would have to have a marked up red line document, so if we're gonna review it and vote on it, that night.
Yeah, I mean, if the changes are,
If they're all done, that's one.
well, I mean, if they're all acceptable to council and council could endorse them, I think it might be just a
Okay,
very
yeah,
easy
okay,
meeting,
yeah,
right?
yeah.
Or if there has to be more in-depth discussion, like, no, we shouldn't do this, and then council gives us, a good reason why we should or shouldn't do something.
Okay,
Okay.
Then we'll have a better idea, because council will have already reviewed it. But if council's accepting of most of the changes or gives a good reason where people are satisfied,
Okay.
it could probably be an easy evening.
Okay. Yeah, I mean, I'll have everything organized, so.
Yeah.
The document will be easy to kind of hit.
Would you mind sharing the changes that you have suggested for the town side?
Yeah.
So that way I can see if because the documents are very, very
Very
similar.
similar, yeah.
They're different bargaining units on the town side, but if you're making some suggestions to wording, I'd
Mhm.
love to put it into the board side and we can send her both at the same time.
Okay, yeah, I'll do that.
Okay, great.
And
Thank
probably
you.
if you did share it, then someone, then you'd want to have the copy, like, oh, you already had that.
Yeah. So around November 1st. Making myself a note to send to you.
Yeah, perfect. Thank you. Whenever you're done.
Okay.
It's all good.
All right, great. All right, so thank you all for that. And then we also have the 2026 joint meeting dates, which I think are in the back.
Motion to adopt the 4 meeting dates as proposed, being January 22nd, April 23rd, July 23rd, and October 22nd as drafted.
2026,
2026.
second.
Any discussion? Hearing none, all in favor?
Aye.
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 Thank you. So I'll sign this one and give it to you.
Yeah, and then I'll get it to Vita.
Okay. All right, motion to adjourn.
So moved.
Second.
All right. Have a good night, everybody.